Hello there. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And if we have a question from you that we don't have a chance to answer, please go ahead and leave your phone number as well in the chat, and we will make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's guests. Today's moderator is Joe Dallow. He truly enjoys serving his clients and helping them plan for the future. He knows that the services he provides can help others meet life goals and avoid unforeseen problems. And perhaps the best part of Joe's job is to help clients protect their families, homes, assets, and dreams for the future. Joe graduated from Lawrence Technological University with a Bachelor in Science and Electrical Engineering before completing his law degree at the Thomas M. Cooley Law School at Western Michigan University. Joe's engineering background combined with his legal training and financial planning background gives him a logical problem-solving approach to estate planning. And we're so excited to have Joe here again. He's moderated and presented for us before. Joe, why don't you go ahead and say hi so we can see your face.
Hi everyone. Thank you for joining us. It's great to be back on here. I love doing these things. We've done quite a few webinars so far and they've turned out great and they're very informative. So we like helping people educate themselves to learn more about various topics that can be helpful.
Well, today's topic is really a great one, and we're really excited to have William J. Mansour here today. William has a bachelor's degree in accounting from Michigan State University and a master's degree in finance from Walsh College. He worked for PricewaterhouseCoopers, UHY, and subcontracted for various small firms. He has been a sole practitioner and a prior partner with Ted Funke and Associates. And currently he's the managing director with WJMCPA PLLC. And I will say I've seen a preview of this content today. And those of you who are in business for yourself or part of a business management, you're really going to enjoy this content today. Really great. So William, I'm going to go ahead and turn the time over to you, and I'm excited to hear you present.
All right, thank you very much. Honored to be here. Thank you all for attending. Great intro. Made me sound a lot better than I really am. But yeah, William Mansour, Managing Director and Founder of WJMCPA PLLC. So today we're here to talk accounting and taxes for the self-employed, aka business owners, or maybe a side hustle, or people operating businesses. So this really does apply to whether you are titled self-employed or just a business owner. This really will help kind of go through all of the, I wouldn't say all of it, but a good amount of topics in regards to accounting and taxes. So first and foremost, what I like to discuss is the types of business entities. You've probably heard of all these. You've probably created one, if not many, LLCs already. But in regards to taxes, there's 5 designations for businesses primarily. Okay, one being single member LLC, partnerships, LLCs, C corporations, regular corporations, and S corporations. We're going to get in a little detail about all of these. So let's first talk a single member LLC. So a single member LLC has one owner. It's a simple entity. It can have an IRA, KIOG 7 for retirement planning. For tax purposes, you do file a Schedule C on your personal income tax return. So there's no separate business tax return with your business as a single member LLC. Your income is all subject to regular income taxes as well as self-employment tax. And you're not a separate entity, like corporation. Whereas a corporation, S corporation or C files a separate business tax return, you are technically a separate entity. Let me clarify that legally. But for tax purposes, you don't have a separate entity that files a tax return. And I'm not an attorney and not giving legal advice, but in general, I think everybody kind of knows, not everybody, but this protects you from self-liability when you are a single member LLC. So let's talk partnerships in general and limited. So a partnership by nature has multiple owners, more than one. So general, and there's two types of classification of partners. There's general partners and limited partners. A general partner, so this is not an LLC that's treated as a partnership, which we'll get to. But general partners have unlimited liability and they run the company. Limited partners have limited liability. They're usually the investors or money contributors, or maybe somebody who gave a loan for equity or so on and so forth. So you can have, I think one big difference you're going to see about partnerships compared to other entities is you can have multiple methods for allocating profit and losses as well as capital in a partnership. Partnerships are taxed at the partner level, so they're what's called a pass-through, flow-through entity. I think we will get more into that. But there is a separate Form 1065 business tax return, which shoots out what's called a K-1, and a K-1 goes to the individual's personal tax return, just like a W-2 would be attached to a personal tax return. Partners do have personal liability, primarily general partners, but even limited partners can have some liability. So again, that's more of a legal. The goal here is to discuss the tax implications. LLCs with multiple owners. Basically, just as the partnership was shown on the previous slide, LLC with multiple owners, more than one, 2+, are treated as a partnership for income tax purposes. So all owners are treated similar. You have limited partners, which would be an other LLC member, or you have a managing member, which would be more of like a general partner in the partnership example. Similar thing, you can allocate profits and losses as well as capital depending on your operating agreement, or however you guys desire, however the owners desire. But an LLC has the option to check the box, which is just a term for you can be treated as an S corporation or a C corporation. It's an election that you can make to be treated as an S corporation or C corporation rather than a partnership or a single member LLC, even if you're one owner. So LLC kind of gives us the most options in regards to tax treatment. Again, you're still an LLC for legal purposes, but for tax treatment, you can elect to be treated as an S Corp, C Corp, or naturally you're a partnership or single member LLC. And similar to partnerships and a single member LLC, all the income and loss flows through to the individual owners via K-1. So I think last on our list is C corporation. So a C corporation does pay its own taxes. I'm sure you've heard subject to double taxation. So when the company earns income, there's a corporate income tax, and then when money goes out, most used ways, I mean the most popular ways are most heavily used ways, whether it's compensation or dividends, right? Then that individual who either receives the dividends or the compensation via W-2 payroll pays taxes on it. So that's why you hear C corporations have double taxation. I think normally it's used for companies looking to grow a business, with whether it's internal capital or going public. It is the most flexible with type of owners, the amount of owners. S corporations can have only 100 less owners, so C Corps gives you a lot more flexibility in regards to the number of owners. Income tax rate, it has had lower initial income tax rates. Depends on the year in regards to tax rate. So, but there's also double taxation when you sell the company or liquidate the company. And then owners do have liability protection of their personal assets similar to an LLC. As corporations, small business corporations, primarily used as a small CPA firm in regards, most of our clients are S corporations and small businesses. So it's one of the best tax saving tools, and I think we'll get into detail about that later, but it is limited to certain types of owners. You can only have less than 100 owners, including family members, though you could possibly have more than 100. Income does flow through to the shareholders, similar to a partnership, via a K-1, and you do file a separate tax return form 1120S. You do have a limited liability protection. Again, an S corporation is only a tax status. It's not, at least in the state of Michigan and pretty sure pretty much all states across the country, S corporation is just a tax status, not an actual legal status of a business, because an LLC can elect to be an S corp. A C corporation, a for-profit corporation can be elect to be an S corporation, and so on. And I think the biggest part of self-employment tax is about S corporations is that you can avoid the self-employment tax that partnerships and individuals face. So it's a big tax savings opportunity. You still do have to pay reasonable compensation according to the IRS rules. So we'll get into a little more detail about that later on.
Okay, well, there are a couple of questions that we have. I'm
Yeah.
going to ask them to you. Is there a limit on the number of owners with an LLC?
There is not. If you elect to be an S corporation as an LLC, you'll be limited, as you see on this slide here, or as I just discussed. But an LLC that's naturally treated as a partnership can be, whatever type of partnership, even publicly traded. You'll even see large companies be LLCs. But yeah, there's no limit to how many partners.
Okay, and then why would someone choose an LLC as opposed to an S corp or a C corp?
So an LLC two aspects here, legal and tax purposes. An attorney can tell you better, like Joe over here, who, we do have an attorney, but an LLC is a limited liability company. It gives you just that, limited liability as an individual. And then you're naturally treated as a single member or partnership, as we discussed, and you can elect to be an S corporation or C corporation. So why would you choose to be something treated as a C corp or an S corp rather than just a natural single member or partnership? It's because tax, could be multiple reasons. By going S corporation, you can save on the self-employment tax. Okay, that's a big deal. And then if you plan to, possibly go public, or you're looking for, international owners, S corporations cannot have, and I think I get to the detail later, but I'll just say now. So S corporations cannot have a foreign owner. They cannot have a corporation be an owner, nor can they have more than 100 owners, shareholders in the business. So there are rules limiting S corporation, who can be an S corporation, because it was created for small businesses, as S corporation stands for. Does that answer the question, Joe?
Yeah, thank you. And thanks for going over for the type of businesses and answering those questions. And then what are some best practices for record keeping?
Record keeping, yeah. One of the first things I like to discuss with business owners is record keeping, because being a one-man show or just starting out, even with people and employees, it's hard to, it can be lost in its tracks. Record keeping can be just get lost in its tracks, and we're busy and running around, but I can't express how important it is to have good record keeping practices from day one. So here we go with some record keeping practices. When the business entity is established with your state, you then want to apply for an employer identification number with the IRS. This can be done online, fairly simple. I'm sure you can hire someone to help you with it, but it is pretty simple to do online nowadays. Sometimes you have to do it by paper, depends on the business. or maybe if there's just online issues. And if you were filed by paper, it's called the Form SS4 to get your employer identification number. People also use EIN interchangeably with tax ID, all pretty much the same thing, but the technical name is an employer identification number / EIN. So what I recommend for record keeping practices is immediately create a separate business bank account, primarily because it helps prove what income and expenses are business. When you have a lot of personal income, maybe other company income, or especially personal expenses going out of the business, it gets very hard to defend in the case of an IRS audit, which we all know is a low chance of being selected, but the IRS does do audits. So as a CPA, and like I tell my clients, if I can't take a position that I feel confident that I can win against the IRS, it's not a position I take because I have to sign that tax return. So it's very important to create that separate business bank account and create that separation. There could be legal issues also, but in regards to tax returns and taxes, you need to keep the income and expenses separate from personal and business. So what I also recommend next then is to start a record keeping system with a software. QuickBooks Online and QuickBooks Self-Employed is highly recommended. It's the number one small business software for a reason, or even the local desktop. But the QuickBooks Online gives you that cloud-based. You can have your accountant log in freely whenever, wherever. You don't have to worry about passing around files. Very simple to use. It'll sync with your bank accounts and helps track business trips, which we'll discuss later. But whatever software you use, it's highly recommended to have some type of accounting software rather than just a Microsoft Excel or trying to keep record of it on your own. So here's what I recommend keeping the following on file or scanned electronically. Receipts, invoices accompanying every transaction shown in your bank account. This is required by the IRS if you were to be audited. Monthly bank statements for the whole taxable year, as well as monthly bank reconciliations for entities especially that report a balance sheet. I think every business should do monthly bank reconciliations. A bank rec simply compares what you have in your accounting software to your bank statement, confirms that you have all transactions recorded. And that's the first thing an IRS agent would ask you for in an audit. Give us your general ledger, your monthly bank statements, and bank reconciliations, because it helps show that you have the appropriate records. I do get the question all the time, how long must I keep the receipts and records for? Generally, the statute of limitations for the IRS is 3 years. So generally 3 years. I know you hear the 7 years a lot, but 7 years is also good to keep your records for, because if the IRS believes you have a 25% or greater material, which is a material misstatement on your tax return, they can go back 7 years. Now, if you've committed fraud and you're filing tax returns fraudulently, there is no statute of limitations. You can be audited for an unlimited amount of time, but generally we say 3 years, 7 years, in case the IRS believes you made a greater than 25% mistake, or mistakes do happen. So, but now with most tax returns being electronic nowadays, it's not as hard to keep the records anymore like it used to be with keeping paper files in a filing cabinet. So I do recommend electronic, because you can keep it as many files as you want. They're not very big PDF files. So.
Oh, I think we had a question come in.
Yeah, I just saw that. Can you talk a little bit about cash versus accrual-based accounting and why someone might want to do one versus the other?
Yeah, I don't think I get into that in this presentation, just because it can be quite detailed. But my answer to it would be, it depends on the business. You hear this from attorneys and CPAs a lot. The answer is it depends. Okay, so cash versus accrual. Generally, professional service firms like a CPA firm that I own, that I founded, and I are on cash basis, right? Because legal firms, most professional services, even dental practices, medical practices, because you can have a large amount of accounts receivable sometimes, especially like we're CPA firms where we do year-end tax planning. But a cash basis basically is recorded as income is recorded as collected and expenses as paid. Okay, so money in, money out, basically. Whereas an accrual basis of accounting is GAAP, generally accepted accounting principles. a little matches your income and expenses a little better according to, GAAP. So, if you have payroll that hasn't been paid yet, you would accrue for it. In regards to, you have then accounts receivable and accounts payable where, income is tracked, is recorded as earned, not as received. So if you've satisfied all the services now on an accrual basis, you would capture that income because you've earned it. So it gets very complex. It gets very detailed. I am not an audit person. Admittedly, I'm not the most sharp gap person. I know it very well in order to do tax returns, but most small businesses don't have very complex gap issues, but a public company does, for example. So I am definitely more of a tax consultant and preparer than an audit person who understands gap on a, definitely on a public or large private company level, because I primarily deal with small businesses. Okay, more record keeping practices, 1099. So first, general rule of a 1099 miscellaneous, also a 1099 NEC, non-employee compensation now is actually the current form. If you've paid any person for services or rents, prizes and awards, excuse me, or other income payments in greater than $600, you need to issue a 1099 to that person. If it's any less, you don't need to issue a 1099 to them because it's under the rule of $600. Most services are reported as non-employee compensation. If you're being in a self-employed service business, it probably means you're going to receive some 1099s. And that basically is just, sent to the IRS. They're going to match it to your tax return and try to, they're going to expect to see that income on your tax return. So here's some good practices for 1099s. What I always recommend to my clients is request a signed form W-9 from every subcontractor or anybody you pay for services before you even pay them. Because in experience from various clients, I won't say an industry specific, but building, just joking there, but contractors or whatever, any subtype of contractor, whether it's building or whatever company may be, if you wait until January 31st when the 1099s are due to be sent out, all of a sudden a lot of people tend to go missing in January. So I always recommend before you pay anyone, get a W-9 fill out. A W-9 form simply gives you their information, name, address, and social security number or business EIN. You are not required to issue 1099s to corporations. So if you see on a W-9 that you're paying a corporation, you don't have to issue them a 1099, but you still want to keep that W-9 on record in case you're ever questioned for issuing 1099s by the IRS. And this is primarily for check and cash payments. Credit card payments have a different rule, things of that sort. And it's for services, not products. That's a very important part of it. So deadlines, I already said, they're due January 31st to the recipient and January 31st to the government. Sometimes, and generally, you can request a 30 days to submit them to the government. But if you have them done for the recipient, you probably have them done for the government also. So you might as well meet that January 31st deadline. Here's an example of a W-9 form. If you're a business, you would still fill out your business on line 1. Only if you're a single member LLC, which would have a disregarded entity name, would you put your personal name on line 1 and then the business name on line 2. Now, this is very important. If you check the box individuals in box 3, check the box individuals as sole proprietor or single member LLC. So you're one owner of an LLC and you haven't elected to be treated as anything different. You are required to put your social security number, not employer identification number of your business, even if you have both. Now you can see that box under that, which shows limited liability company, and you would then put a C if you're treated as a C Corp, S for corporation, or P for partnership. In that case, you would put the EIN of the business. But that's just a general. I think there is a revised one, but they don't. This form does not change that often. It's pretty similar every year.
Okay, I have a couple questions.
Sure.
Does that mean you have to issue a 1099 to suppliers like for raw materials, or what about the people you rent your office space from?
Not materials. So any physical product is not required to be issued a 1099. But to your landlord, yes, rents. If you pay them rents, technically you are required to issue them a 1099 miscellaneous and put it in the rents box. Now, there's 1099 non-employee compensation was just begun last year, and that's for non-employee compensation. But you would just issue that for somebody you paid for services, not for material. That's why you also need an invoice to break out material and services sometimes.
Okay. Okay, cool. So now that we have our business type and our record keeping practices down, how do we save money on taxes?
Yeah, this is the fun stuff. So this is why I love doing what I do. Because we can talk about how do we strategize. I think I get into some basic stuff here about expenses, but this is where, being a CPA is fun and not just number crunching and the term bean counter where that, that's been around forever. So I think I'll save it for when we get to the slides, but this is really where a tax practitioner who is a planner and consultant, that's why they get paid the big bucks, I'll say. It's more about strategy and planning. How do you save the client's money? How can we strategize before the year is over? Don't just come to us once a year when the year is already over to do your tax return, because at that point we're done. We're stuck with what happened in the prior year. But if we work together throughout the year, once, twice, quarterly, even monthly, we can strategize to save you money in taxes. And that's the bread and butter of what I do. So first, there's a general rule about income by the IRS, and it says business income is all money received for goods sold or services rendered, period. Meaning if you find $1 on your way parking in a structure, you technically have to pick that dollar up as income. Now, I use that, my professor from college, by the way, used to say a quarter. I'm going to bump it up to $1 because, you actually do have to round up, 50 cents and up. You round, there's no pennies on your IRS tax return. And the rule actually then goes to say, except where it's not income, basically, in lame terms. So there's exclusions, of course, of what income is. But in regards to expenses, the IRS states that any ordinary and necessary expense to run your business is deductible. Except, so there's always, it depends, with expenses also, because some people will, I'll just say, people can get creative with what is an actual ordinary necessary business expense. So let's get a little more specific for the self-employed business owner. So here's an example. I just like throwing this in there of a Schedule C for single member LLCs. And I just like to go through a few of these, advertising, car and truck, auto expense, which we'll get in more detail about, commissions and fees, contract labor, somebody if you issue them a 1099. That's where that would go. Employee benefits, insurance, interest, office expense, pension, rents, repairs and maintenance, supplies, taxes and licenses, meals. We're going to talk about deductible meals, utilities, wages paid, and then other. So these are just some good big general ones that are on a Schedule C, but it's not the only. These are not the only expenses you can take on a business. So meals is a big one. Currently, and this is dependent on tax year, but you can deduct 50% of meals paid for client meals. I'm sorry. So again, this changes. Some years it's 100%. Some years, most recently, it is 100%. But this is generally the rule is 50% of meals. No entertainment. The entertainment is no longer deductible. But what's important here is what do you have to keep in regards to proof and record keeping? So they need the name of the restaurant, the date, which is normally on the receipt, right? And the detailed list of meals, as well as the one that shows, the tip and how much you've paid. That's important that you get that detailed receipt. Then what's not on there automatically is you have to put the first and last name of all who are attending, and then the business purpose, film planning, and maybe an investor meeting. Those are a couple examples, or tax planning with my clients is one that I use all, because we're having a meal talking taxes is what I do quite often.
Okay, we have a question. What about snacks or drinks at the office? Is that also 50% deductible?
Total different rule. Okay, so this is for client meals only. That would be just more simply put, that's 100% deductible. Whether you call it office expense or traditional recreation, that's another debate of where to put it. But snacks for the office that are 100% at the office, sitting there for employees. Same thing with meals for training meals. Anything that is done, and in layman's terms, and just to keep it basic, anything that's done to improve your staff, or maybe like a lunch and learn for your staff, those are 100% deductible.
Okay, awesome.
Okay, vehicle expense. This is a huge one, and it can get complicated. Let's try to keep it basic. So generally, for vehicle expense, you pick one of two methods. And this also depends on your entity type. But this is definitely for Schedule Cs, and then a little different rules for others. So there's a standard. You have one of two options is to take the standard mileage rate. For 2021, it's as you see here, it's 56 cents. And that changes every year depending on the IRS. Now that includes maintenance, oil changes, gas, things of that sort. So they combine all that based on market prices and market rates. That's one method, is taking the standard mileage. The other method is actual car expenses, where it's based on a percentage of use of vehicle. So let's say you use your business 60%. Let's say out of 10,000 miles, for easy math, you spend 6,000 for business, you'd have a 60% deduction of your gas, the depreciation of the vehicle or lease expense, maintenance, oil changes, so on and so forth. But when you choose one method for a certain vehicle, you're required to keep that method until that car is disposed of, or until you get a different vehicle. Here's where, what type of driving mileage or is business. So home to your regular main job, as you see there in the middle, never deductible. To home to a temporary work location, deductible if you have a regular main job at another location. From a temporary work location, like let's say a doctor, for example, has a main office, but then goes to the hospital to see patients. From the main office to the hospital, that would be a temporary location, always deductible. Home to a job, as you see in the bottom, not deductible, but from a second job to another temporary work location, deductible. So this chart can look confusing. I might have just confused you with the way I said it, but in general, your home to your main office is not deductible. Now, if your home is your main office and you take a home office deduction, which we'll discuss later, that's opens up a whole discussion of driving to each job. Is that now deductible? But that's possible. Just a few, visiting clients or customers, going to business meeting, away from workplace. I think we kind of covered that on the last slide, but this is just a little more detail on it. All right, so home office expense. So I kind of picked out a lot of self-employed examples, not geared so much towards corporations, which, like I said, we do like the S corporations. Even if you're only one person, S corporations can be very beneficial, but there is a dollar number where it's like, when does it make sense to be an S corporation? Kind of. I expect that question. When does it make sense to become an S corporation in regards to profit? That's kind of a very relative, it depends type question. So home office, do you use a specific room in your home for business? If the answer is yes, meaning you have to not use it for personal use, you have to have a separate lock on the door with a separate key from any other key in your house to prove to the IRS that this is a home office. Then you can use the percentage of square footage of your office compared to your home. In the example here, if you have a 10 by 10 room, and you can consider that your home office in a 1,000 square foot home, you can take 10% of the indirect expenses. Direct expenses are fully deductible. We're going to get to that, I believe, in the next slide. Here's an example of direct and indirect expenses. Direct, again, are deductible in full. If you're painting that specific home office, because you're trying to improve its look for business. Deductible. Indirect things are insurance, utilities, general repairs, not one specific to the house. I like to throw in there security systems, internet, telephone, a percentage of all of that could be deductible and an indirect as an indirect expense. And then unrelated would be lawn care, painting a room that's not the home office. Those are totally unrelated and not deductible. Examples from your, this is just actually the schedule, which I actually, this is actually just the schedule you'll see on the home office deduction, where, it just lists out, mortgage interest. Mortgage interest is a big one, actually. The depreciation on your house is a big one. Real estate taxes, and we kind of discussed the rest of them already.
So those are all great tips for, for business owners. And then, so do you have any other information that may be important for people who are self-employed?
I think we'll get a few more. Hopefully I give you a little more. Yeah, definitely. The rest of it is geared towards self-employed individuals. I think now we're talking taxes. I think this is probably the most important part. People don't realize and know. So let's kind of get into it. And then if by the end of the session, or if you come up with another question, feel free to do so. If I don't answer it, through the rest of the seminar. So let's talk self-employment tax. Okay. This is the difference again. The S corporation is a big one between partnerships and single member LLCs, or sole proprietorships and partnerships. So self-employment tax consists of paying both 6.2% Social Security, 1.45% as an employer, and then the other side of 6.2%, 1.45% as the employee. Now, if you're employed as an employee at a company, you only pay that combined 7.65%. Your employer is taking the share and paying the other 7.65%. But when you're self-employed, you're the employer and employee. Okay, so half of it is deductible as a business expense. However, I even this slide I created here, you're not totally net paying a 7.65%, but in general, you do get a deduction for the employer paid portion of this. But self-employment tax, the 15.3% combined, which is a huge 15.3% tax to self-employed individuals, separate from income tax. Yeah, I'm sorry. Let me just make that point. There is self-employment tax here, and as well as you pay income tax. That's the general brackets. 0 to whatever percent, 37, 39, whatever it is for the year. You also pay that income tax rate plus this possibly capital gains rates if you have other, capital assets or capital transactions. But, qualified dividends and capital gains have a special tax rate. Okay, thank you. So, taxes for the self-employed. Now, unlike when you're an employee, you're getting your taxes withheld out of your paycheck and submitted to the IRS and state automatically, and that's how you usually get a refund, because you just overpaid the IRS is what a refund is. When you're self-employed, you're required to pay those taxes evenly throughout the year. This is very important because heavy penalties and interest exist in the state of Michigan where I am, the IRS, and I'm sure whatever state you're operating business in. So they're due in 4 even payments. Again, subject, it depends, but generally 4 equal payments, but the due dates are always the same unless it falls on a weekend or holiday. April 15th, or for example, the COVID extension, they did extend it to May 20, questionable, actually, I'm sorry. These are generally the dates. We'll leave it at that. April 15th, June 15th, September 15th, and January 15th of the next year is when quarterly estimates are due. Taxes must equal 90% of the current year tax, 100% of the prior year tax, or 110% of the prior year tax if prior year AGI is greater than 150,000 as of currently, and that 150,000 number can adjust for inflation, but that's where it is as far as we know now. I'm at the end. Wow, I haven't filled up a full hour. This is surprising. Usually I'm going on and on, and I do get a little more detail about the S corporations and why we like S corporations. If there are any Q&A, let's do that. But that's probably how I can fill the time. And I think I follow the slide a little more. I've been trying to be appropriate and professional in the best way possible. But when I do this live in person, you get a little more personality and I can talk quite more. But here we go. Maybe a good time for Q&A.
Yes, it is. And I'm sure we'll have more questions here. So
Yeah, I have a couple of them already. So, okay, so with so many people at home during the pandemic, what other sort of expenses from working from home is tax deductible for business owners?
Um, I would say for business owners, pretty much all of the things I mentioned, you know, the home office expense. Now, the home office expense is one big one, right? Because you're working from home. I don't think really much changed in working from home as a business owner. Now, in the past, as an employee, you could get the home office deduction as an employee. And now that's where a lot of people who used to work in a corporate office would go home and work. Uh, I just noticed. So if you're an employee and now you're working at home, like due to the pandemic, for example, you used to get what's called an employee home office deduction on a form 2106, which is an itemized deduction, possibly if you're going to itemize rather than take the standard deduction. So again, a whole different topic. But as a business owner, I think I kind of hit them all from a home perspective. But anything you feel like is paid in addition because of your business, it could qualify as a direct expense of the pandemic. Maybe if you're getting hand sanitizer or maybe you're sanitizing your home a little more, paper towels, gloves, masks for your customers. Those are probably things that, due to the pandemic you never really had or you had a lot less of.
Okay. And then can you address corporate rent for an S Corp for your monthly board meeting, and what are the limits for that?
Okay, I think I'm hearing this because of TikTok, the Augusta rule. So generally rent is a full deduction, right? Corporate rent, or however you want to call it, rent expense is an ordinary and necessary business expense. Joe, you mind repeating that question? I want to make sure I heard it correctly.
Yeah. Can you address corporate rent for an S Corp for your monthly board meeting? What are the limits?
Yeah. So there's no really difference for a board meeting, right? You're still paying rent. Now, I think if the question is asking, and apologies if maybe I'm misinterpreting it, you have a board meeting at an outside resort, or you're using your home because it is a very nice on the water lake for board meetings.
Yeah, board meeting at your home.
At your home. There we go. Okay. Sorry if I didn't hear that.
No. They just clarified.
Yeah. So the Augusta rule. So this is the big one that I get asked a lot now, honestly, because of social media. The Augusta rule says basically, and it was created because of, the golf, excuse me if I don't know it, Augusta's golf related, the tournament or whatever, the golf. Some of my friends are going to make fun of me for if they see this, but I know it was related to
the Masters.
The Masters. Thank you.
I'm a Georgia resident, so know that well.
This is where the rule came about. The people were renting out their homes for this Masters golf tournament. And again, excuse me if I'm saying it wrong. And then the IRS, basically it came about that if you rent your house out for 14 days or less, you do not have to pick up that income on your personal tax return, because if you're just renting out your personal residence for a board meeting or to a stranger, you technically have to pick that up as rental income on your personal tax return. So you get a deduction on the corporation, but then you as an individual business owner or whoever you rented the house to has to pick that up as income. The Augusta rule basically says if you rent it out for 14 days or less throughout the whole year, 365 days, you don't have to recognize that rental income, but the business can get that expense. So relative, it depends. Talk to your CPA. I'm always open for questions, whether it's this seminar or emails, but talk to your CPA, discuss that with them. I'd be happy to answer any questions. I'm always available, whether you're a client or not, happy to help with any more detailed questions on that.
Awesome. Okay, so a couple more questions. How does contributing to your retirement fund reduce your tax rate?
Absolutely. This is huge, especially for financial advisors like we have over here, Joe Delu. Um, it's a business deduction. At the end of the day, retirement contributions are a business deduction for your business, whether you're a Schedule C, an S corporation, C corporation, whether you're paying for an employee's retirement plan or an individual, self-employed SEP plan is for short. So it is a deduction. They're subject to certain limits. Financial advisor will help you with those limits, but in general, in an S corporation, it's 25% of compensation is the max you can contribute. And then there's $1. It's, changes every year for inflation, so, and then there is, if you're a Schedule C, there's a calculation to, just trying to keep it basic here and simple. There's a calculation of your maximum or there's $1 maximum. Whichever is lower is the deduction you can take. And that's something, you'd work with your financial advisor, and why it's important to have a good financial advisor and CPA team that work together possibly. If they don't, I'm sure, I've worked with many financial advisors who I don't regularly work with, but my clients have as financial advisors.
And then can you talk a little bit more about the advantages of an escort?
Yeah, S corp. So we love the S corp because of saving the self-employment tax. Obviously, there are also certain deductions you can take. I don't want to get too detailed, but there are certain deductions you can take for S corporations. That are treated. That are just different than a Schedule C. But most importantly, is the self-employment tax, avoiding that, and that's how they help IRS helps small business owners. So you have to take a reasonable salary. The question is, what is a reasonable salary? That all depends. Okay. Generally, what would you pay somebody to do your job? And that's hard because most business owners say, you can't pay me enough. I can't pay somebody enough to do my job. I do everything. I wear every hat. I do this, I do that. But generally, if you have maybe a manager take over a certain role or a lot of your roles or one or two people, that's what's considered reasonable salary. That's where the debate comes in. So on that salary, you are technically paying the self-employment tax. You're paying the Social Security and Medicare twice because you're the owner of the business as well as, an employee when you get a W-2. But besides that, you can take your income in the form of shareholder distributions. Shareholder distributions, with a couple exceptions of basis. Basis as an owner is a whole another complex topic. Could bore you to death with that, but talk to your CPA about basis. But generally, shareholder distributions are tax-free as an S corporation, whereas in a C corp, there'd be taxable dividends, or in a partnership, all income is subject to self-employment tax, whether you take it as a distribution or not. And it's not shareholder distributions. For example, you made $100,000 in 1 year. $50,000 went to your reasonable salary. Your remaining 50% profit, $50,000 profit in the business. You still pay ordinary income tax on the $100,000 because you're getting $50,000 on the W-2. You're getting $50,000 on the K-1 as business income. Whether you take that $50,000 out or not, you are taxed ordinary income tax on it. If you take the money out as a shareholder distribution that year, it is not taxed again because you took a distribution. Let's say you paid the tax on the $50,000, didn't take the money out, but you took out the $50,000 out the next year. You're not taxed on that again because you already paid the $50,000. You're taking the distributions in the following year, maybe because you don't want cash flow to be too tight in January. But that's the beauty of S corporations. Shareholder distributions are tax-free. You avoid self-employment tax minus, reasonable salary to the materially participating owners. This is why we really like the S corporations, and it really opens up a few more strategies that I think are too detailed to get into today, but hopefully that helps.
Okay, and then I've heard of some people taking loss on their business intentionally to reduce their overall tax rate. Is that advisable?
In general, I never recommend anybody to intentionally create a loss in their business because then you're losing money, right? You're out of your pocket. Okay, but I understand what what your question is, I think, and what most people are thinking. you can create loss within the tax rules. One big way is depreciation. I'll give one big example. You buy a $100,000 machine, which is normally required to be depreciated over 7 years. As a small business, as long as you put, the numbers change every year, as long as you put a certain number of assets, lower than a certain number of assets in place, $2 million, for example, is 1 year, or so it's been $1 million, been 500,000. But if you put $2 million or less of assets placed in service a year, for example, and you have a $100,000 machine, you can take Section 179, which would allow you to take 100% of that $100,000 machine as a depreciation expense in the first year, rather than spreading it over 7 years. It's an election you have to make. Some years, and normally we have bonus depreciation, which could be 50 or 100%. Now, bonus depreciation would help you create a loss to offset other business income. But then you have the passive and non-passive conflict. If you have a business that you are materially participating in, it's a non-passive, but you have another business where you're just an investor and it is passive, non-passive and passive income cannot offset each other. Same thing with rental income. Rental income, with the exception of a rental real estate professional, is always passive income. So these are things you have to strategize and put all together on paper, or working with your CPA, or electronically now, of course, and strategize, in June, December, do you need that machine? I always first ask, as much as I'm a tax CPA, is there a business need before tax savings? Because at the end of the day, you're going to be out of more cash with more cash out of your pocket by buying something you don't need, rather than tax savings. If you're in a 30% tax bracket, for example, and you spent $10,000, you're going to save $3,000 roughly, but you're still out another $7,000 in your pocket. Okay, so to me, it's not a good strategy, at least as I advise my clients, to purchase things to create a tax loss when there's no business purpose for it. It has to make business sense before it makes tax sense. Now, if you need that machine and you're going to use it in January, or you could use it in the month of December or June when you're planning for it, absolutely. Now we're creating a tax deduction, which is saving us $3,000 for a $10,000 machine that's projected to make us $100,000 in the next year. So is there a business need, is a question I ask my clients before, do we need a deduction for tax purposes? If that makes sense. So.
Yeah, that's definitely makes sense. Okay, I have another question. It's what is considered a reasonable salary for the S Corp? Is there a certain percentage that is a good recommendation?
It's relative. I can't give a percentage. Sometimes, you kind of think of a percentage, but it's I'll put it this way. The IRS does not give a percentage. It depends on the dollar amount, depends on the industry, the type of business, what your role is in that business. So no, the IRS doesn't give a percentage of S corporation profit to qualify as reasonable salary.
Okay. And then who would you go to in order to change your business entity from like an LLC or an S Corp or C Corp?
Your CPA can do that because that's the tax classification. So your CPA can either file, an election to be treated as a C Corp or an S Corporation. But usually, your CPA should be able to help you with that.
Okay. So how does it work from an accounting perspective if you purchase inventory, let's say in 2021, but you don't sell it until the next year in 2022?
Yeah. So inventory, and on a cash basis, you don't have inventory, right? Because you paid for the product. It's an expense as paid. On an accrual basis, you have to capitalize your inventory and sold. You have to match it with when it's sold in order to expense it. You can also have a hybrid method of accounting where you have inventory, even though you have no accounts receivable or accounts payable on a cash basis. So it all depends on the type of method of accounting you have of when inventory, is an expense. And again, inventory is a sensitive topic to me because I think a lot of people confuse supplies and materials with inventory. If you're in a service business like a contractor, but you have material like mulch, for example, is a big one, and you have 1,000 yards of mulch sitting in your warehouse, but you don't sell mulch. You just use it to provide your service, and it's part of your service. That's not inventory. You have no cost of goods sold. This is an argument I'll get into a lot of other CPAs. I probably shouldn't have said it. But in general, in regards to expenses, in regards to inventory or product, you have to ask yourself, am I selling a product? Then what is my method of accounting to decide if it's deductible or if you have to capitalize it on the balance sheet?
Well, I hate to cut this off, but I think that's about all the time we have for questions. Excuse me, a little frog in my throat there. On behalf of Advice Chaser, I want to thank both Joe and William so much for being here and for the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find an advisor who is a good fit for your life and your financial questions. And if you would like to use our matching service, that is free to you. All you need to do is go to advicechaser.com and click on the link to find an advisor. So once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.
All right. Thank you all so much. It was a pleasure. Very enjoyable.
Thank you.